TheoTrade. This is Don Kaufman, September 4th, 2021, doing the TheoTrade weekend update here on a Saturday morning. Welcome, of course, to the Labor Day holiday weekend. U.S. equity markets are closed on Monday, once again, for the Labor Day holiday. Let's get right down to business here because, hey, we are in the month of September. And will some of that September volatility really kind of live up to the hype? For those of you that speak a little bit of market geek, you will know unequivocally September being a wildly volatile month, again, historically speaking. So we're going to look at all aspects volatility here momentarily to try to decipher, is some of that well-known September volatility forthcoming? Before we get there, let's actually just do a really brief overview of this past week of trade, because I got to tell you, this past week of trade, holiday trade, just drove us to a low volume, low volatility slopfest. I mean, I think the one thing that just exemplifies this, you're looking at a 1 hour chart right now inside of the S&Ps, and the entire week of trade here, what did we do? Absolutely nothing. Just a really, really mild grind to the upside. And there's a few sectors that made some substantial moves that I kind of want to elaborate upon for just a moment. With that, and before I get into the sectors, though, I think that there was some data out this week that absolutely begs to be discussed. One of those, of course, was the non-farm payrolls. That is, NFP took an absolute nosedive. I mean, in the non-farm payrolls department, this is one of the biggest misses. So the estimate was for approximately 720,000 jobs. We hit 235,000. The interesting part of that, and of course that came out on Friday morning, the market did not initially know how to interpret this particular data. And I'm actually showing you when and where non-farm payrolls came out. You can see some momentary volatility, and the irony is the initial knee-jerk reaction of bad news was still to the upside. Markets then actually backed off and kind of just meandered for the remainder of the day. I wouldn't call this a rally by any stretch of the imagination. There was absolutely unequivocally no volume in the marketplace. About two and a half hours after the cash open. Again, we're coming into a holiday, weekend. Markets just really died out on that Friday afternoon trade. In addition to the non-farm payrolls, there was PMI data that came out earlier in the week from China. And the point that I wanted to make about this is, this really hideously weak data actually caused a rally, not only in Chinese markets, but in U.S. markets to some degree. And again, that data out earlier in the week. Now, that rally definitely faded, but this is something to keep a very, very close eye on because, again, the marketplace, once again, is loving the weak data. And you have to think about this kind of logically, right? You get some weak data, whether it's non-farm payrolls, whether it's Chinese PMI, whether it's our PMI, construction spending, whatever it might be. And that weak data then translates into quantitative easing and low interest rates forever, right? So what you're looking at here now is the TNX. And again, the TNX, if you look back over like the last 15 years, I don't know, I think it's starting to form a little bit of a trend. But the one point that I wanted to make with this, that was the conversation piece, is that on some of this weaker data, all of a sudden the bonds came back to life and saw actually some sell side activity. Interest rates actually ticked higher. So wait a second, you have weak data. Doesn't that mean quantitative easing forever? Okay, so contrary to popular belief, again, the bonds, then again, that conversation piece is the bonds actually saw some sell side activity on the weaker data. And we don't know exactly what to make of this just yet. Simply to say that the bonds are absolutely unequivocally back in play. The other aspect that really, really resonated with me is it's infrequent to see the bonds traded down. Let's just talk about Friday's trading session, because on Friday, again, non-farm payrolls came out. If you take a look at the bonds on an intraday basis, the bonds did get fairly decisive. The bonds, they dropped. okay? Nothing too crazy, but the bonds dropped. And again, that indicates that interest rates actually went higher. So rates going higher on bad data seems a little unusual. You want really unusual? So the bonds go lower. That takes that interest rate, right, the percentage rate higher, but the financials also were down. And that's why I say that the bonds are back in play, but the conversation piece is you had bonds down and you had the financials down, which is unusual to say the least, because again, higher percentage interest rates, as the interest rates typically go up, you know, the financials love it. In this particular case, though, they did not. Now, to kind of further this, throughout the course of the week, I think the best way to delineate this is to cruise over to the auto expected moves. Take a look at the financials. In this last week of trade, the financials sold off, and sold off actually outside the expected move. And again, I'm not using the expected move here to show anything other than the financials sold off, and they did something that was unusual. Unusual being that it's a lower probability to close outside of the effective expected move. At the exact same time, though, that we saw the financials getting whacked back, if you take a look at the QQQ, all right, the Qs closed literally at the upper edge of their expected move. So the entire trading week came down to this, okay? That's the Nasdaq, that's the QQQ went straight up, okay? Then you had the XLF, which is the financial straight down, and what did the S&Ps do? Absolutely nothing. All right, that S&P 500 kind of skirted right through the middle, and that's also pretty apparent by looking specifically at the SPX, the mother of all products. So the SPX, you can sit here and try to argue it closed higher. I mean, come on, we started the week at roughly 45.10. We closed the week at 45.35. We meandered, briefly higher at points during the week, but the other aspect that really resonated with me is I saw the QQQ and I'm looking at the auto expected moves and I'm like, wow, that's just, phenomenal. So the Nasdaq explodes to the upper edge of the expected move, but you didn't see that really kind of resonate again in the S&Ps. Obviously, the Nasdaq itself closed again at the upper edge of the expected move. But what's even more interesting is the stocks that actually drove the Nasdaq. And here again, apply auto expected moves for a second, because it really breaks down the week. If you take a look, what did Microsoft do in the week? Absolutely nothing. Rallied early in the week and actually faded almost back to even on the week. Taking a look at Apple, all right, there you go. Apple, outside the expected move, all right? Amazon, way outside the expected move. Then you start digging into this. Facebook, faded, almost back to where it started the week, okay? Google actually closed the week slightly lower. You got to think about this for a second, because, you're looking at just a handful of products and you start to look at Tesla. All right, Tesla definitely involved in part of the rally. And last but not least, NVIDIA closed the week for the most part almost completely unchanged. So the entire week in very large part was brought to you by Apple, okay, and Amazon. I mean, those are the two products. I mean, and then there were two. The point that I'm just making with this one is that's all it takes to be able to perpetuate a rally right now inside of the Nasdaq, but it is no longer enough just to have two underlyings. You can't move the S&Ps. You can't move the S&Ps, especially when the financials are down. Again, the conversation piece is going to be, okay, we're coming into a shortened holiday week of trade. It's going to be 4 trading days. And the whole conversation piece in this next week of trade, to me, it's going to be the bonds. Because I'm going to tell you exactly how this is going to play out. And it's why I'm actually doing a little bit of a recap over here. The bonds right now are kind of at their inflection point. And by that, I simply mean if the bonds, okay, from this point forward, if the bonds start to sell back off and that interest rate starts to go higher, I'll actually give you this. I think the financials are going to react positively, meaning that the financials will actually head back up. Unfortunately, at the exact same time, if those bonds sell off, they're actually going to start selling tech. Okay, they're going to sell tech, and it will start take the marketplace, and that being representative of the S&P 500 down. Okay, be careful this next week, because again, bonds are going to be back in play. I was saying that, of course, on last weekend's update, but again, it's fairly important for this future week here. The bonds are right towards the lower edge of their range, and any movement lower is probably deemed as risk, specifically to technology. And again, a rising interest rate environment might be wonderful for some of the financials in the near term, but it could absolutely decimate some of the monsters of tech, and monsters of tech are effectively at all-time highs. All right, onward and upward from there. Okay, let's actually start to break down, will some of this September supposed volatility really kind of live up to the hype? And what we look for in this particular circumstance is like a September volatility spike. So I think a lot of people are kind of questioning this, and I want to start with a quick glance at the VIX and the VVIX. So one of the first things that I would denote, if you take a look at, let's open up a 3-year here, specifically on the VIX. I'm going to go ahead and close up this left side bar, and taking a quick glance at the VIX, where we're basically at right now is right in this neighborhood here. Okay, when I say right in this neighborhood here, this appears at this point in time to kind of be a floor of the VIX, and that simply is about the 16 level. So and I'm comparing it to, again, 3 years, because you got to go back and literally look at data from all the way pre-COVID. This was actually the upper edge. 16 was actually the upper edge of volatility few years back, but in a post-COVID world, we are actually seeing a floor of right around 16. I think that's one of the first things that I wanted to note. Why do I want to bring that to the occasion? Because you could actually see volatility crest down to the 14 level, and pretty much anything at this point into the 16, 15, 14 level, to me, volatility is just an outright buy. But I'm actually going to show you that there are some really funky things going on in terms of volatility. So again, volatility gets any lower than this, and it looks like an outright buy. With that, we got to cruise over to the VVIX, the volatility index. Okay, this is actually displaying how volatile are the options themselves in the VIX, and the answer is right now it's actually one of the lowest points that we've seen in quite some time. And again, this is a conversation piece unto itself. If you looked at, again, 3 years of this data, we are clearly, and again, I think this actually should really resonate with you. The upper edge, all right, which is already aligned on the screen, the upper edge of the VVIX over previous years, okay, was at about 110. Now that seems to be kind of like the lower edge. We are in a rather low volatility of the volatility index itself. So once again, this also should kind of penetrate and say, like, hey, if I'm going to be a net buyer of volatility in the VIX itself, anything under the 110 region, looks reasonable to be able to be, buy volatility at this point in time. And again, there's a bunch of trades that we've talked about pretty consistently here at TheoTrade, VIX volatility spreads, where we're actually selling put spreads to be able to finance the cost of out-of-the-money call spreads specific to the VIX. And all I'm elaborating upon here is that's completely and totally in play. Right here, right now, VIX volatility spreads are pricing extremely well. If you need one, you join us, of course, this coming week, Tuesday, Wednesday. I'm more than happy to build a couple of VIX vol spreads. We'll kind of live see if we can get executed at some decent prices. All right, onward and upward. The next aspect, worth noting, has to do with this just massive, all right, contango. And what this kind of breaks down to, and I think the way to kind of delineate this is short-term volatility versus longer-term volatility. So we're looking at like a 9-day VIX. And what I mean by a 9-day VIX, there's literally calculated a 9-day VIX. Here it is. It's the VIX 9D. And anybody can bring this up, and you can see it's 11.66. You come out to 3-month volatility, right? So that's just 9-day. Then we look at 90-day vol, and 90-day vol, it's almost double. All right, you're at 20.32. that is just a gaping hole. So you have to understand what this really means. And this is the important point. The marketplace is already pricing in, okay, significantly more volatility to the back month. Like, it's saying short term, nothing going on here. Back month, catastrophic amounts of volatility. And this is something I was pointing out in last weekend's update as well. Like, I've even looked at 1 year volatility. 1 year volatility is still up in the 25 or 26 regions, even further than this. But this is just a huge gaping hole. You know, what happens between 9-day and 90-day? Like, when is volatility going to just explode up? And that's exactly the point to be taken from here, right? Is that the contango is massive. And again, I hate to use the term like contango. We're going to look at a volatility depth chart here. And what the volatility depth chart is going to bring you to, okay, is the exact same conclusion, well, that I'm going to display to you here momentarily. What you're actually looking at right now, okay, happens to be 11-day volatility futures. And the 11-day volatility futures, they're sitting at about 18 and change, which is almost a full 2 points above VIX. What's crazy about this is that these volatility futures, which are 1826, okay, eventually they settle to VIX. They settle to VIX, which is at 1641. Now, I'm going to just tell you, this is some really quantitative, geek kind of stuff. One of two things has to occur. These volatility futures either have to go down, okay, or this VIX has to go up, or maybe a little conversation piece, a little bit of both, right? So the vol futures have to go down, the VIX goes up. But you realize 11 days, we're in a holiday weekend, so there's just a handful of trading sessions left for the two to converge upon one another. And you're like, well, why does that matter? What I'm getting at is the marketplace is continually pricing in like this. Here comes the shock. There's going to be something big that's going to happen. Maybe it never happens, but it's constantly pricing in, all right, this just wild amount of volatility that doesn't seem to ever come to fruition. And that's one of the points that I'm trying to make on this weekend's update. I mean, here's a better way to actually display it. If you look at the differential in volatility futures, 11-day volatility futures are set at 1826. And then you come out to 46-day volatility futures, they're all the way at 2045. And what that looks like, kind of graphed out, if you cruise over to the charts and the product depth curve, it looks like this, okay? And when I say it looks like this, like these have literally like 11 days left. These have over 40 some odd days left. Look at that gaping hole. Like, what's going to happen between, 18 and, 20? Again, the back month volatility is still pricing in like this catastrophe. This is actually going to be difficult to get out of. So I wanted to show you the volatility depth chart, and we're going somewhere with this, so bear with me here for a second. So you need 9-day volatility versus 3-month volatility. You see that volatility, okay, depth chart. These are the volatility futures. That the volatility futures are like nothing going on now, but there could be risk. There could be bigger risk. It's huge risk. Like the forward future is continually and relentlessly pricing in. Again, a 22 volatility is big boy stuff. Put on your big boy pants in a 22 volatility. I guess the way to compare it, cruise back over to the VIX. Like, look, these are some serious spikes. When the VIX actually hits that 22 level, I mean, those get pretty serious. And yet the volatility futures are constantly proclaiming that volatility is forthcoming. In addition to it, and this is the one I think that's also extraordinarily bothersome, is that the SKEW has been relentless on this particular front. So here we're actually going to go over to an area chart, and I'm even going to back up and give you the full Monty of SKEW. SKEW data right now is way off the chart, and what SKEW is actually positioning, it has to do with the implied vol of out of the money puts right here is sky high. That's all you need to know. So what is the marketplace pricing in when you see SKEW extraordinarily high? What it is in effect is traders are out there hedging, okay, buying out of the money puts and driving the cost of those out of the money puts through the roof. Okay, they're either hedging or they're taking downside shots. And you can't necessarily decipher between those two, but either way, the out of the money puts are outrageous, okay, versus at the money volatility. What does all of this add up to? Okay, when you have out of the money puts and so many people hedging in a marketplace, what does that even look like? And again, I'm actually going to pull up the spiders. I'm just going to go 41 days out, and I have every option here open, and I'm actually going to pull up implied vol. I want you to see what it looks like. I mean, you're looking at like 50% implied volatility, all right? And these options are like, whatever, man, they're at 20 cents. Yeah, but we can go to the SPX, and the SPX, they'd be trading for like $2 or $3, right? Look at these out-of-the-money options here. I mean, we are what? You're 25% crash in the marketplace, and you're still pricing like a 42 vol. What I'm getting at is these 334s, okay? It would take literally a 25% market crash to get all the way to 334 from where we're currently at, which is 453. And there's still huge volatility out here. So somebody is buying these, okay, and they're buying them. It's not because they necessarily think the market's going to crash. They're buying them, okay, expressly because it could, okay, or they're hedging. What this leads us to believe is that the world is very, very well hedged at this point. Why? Because they're buying back month volatility. You can see that in the SKEW. They're buying back month volatility. You can see it in the volatility depth chart. They're buying back month volatility. You can see it in 3-month volatility. You have to understand at that point, every time the marketplace sells off, nobody gives a crap. Why? Because for the most part, the professional world is hedged. Think about that for a second, which leads us to believe, and this is the opinion piece, it would take a fairly large shock, I call it an exogenous shock, needed to kick off, okay, the September volatility festivities. You can't just come out of this with a slow grind to the downside, people. We would actually take a fairly significant shock in the S&Ps to actually kick volatility into high gear. What you would see, all right, is short-term volatility needs to actually eclipse some of like the October volatility, or October volatility needs to eclipse, okay, the November volatility. Vol has got to get inverted. The only way that we're going to see that, in my opinion, is a big shock to the marketplace. We're not going to slip slowly into a more volatile market is what I'm getting at, okay? We're either going to go for it or we're going to actually be in a low volume, low volatility slop fest for the remainder of September. At this point in time, again, I think you just have to be on your game and anticipate that the only way out of this massive volatility contango is through, a little bit of fear and loathing in trading. And I'm going to tell you right now, to get out of this, okay, we're going to need some ugliness to apparently hit the marketplace. Now, that's not me being, a bearish connotation. It's just the reality of the amount of open interest, okay, the amount of, again, contango in terms of volatility, and what is going to be a necessity to actually shock us back into a more volatile September. With that last aspect I wanted to cover here on this weekend update, as we do each and every week, expected move. I am the first to say that I am pretty shocked, okay, at how low the overall movement was in this past week of trade. The past week of trade had, roughly speaking, a $57 anticipation of movement. So we were looking for plus or minus $57 in this last week of trade, higher or lower. What did we get? Nothing. I mean, we were literally, at 45.10. We got all the way to, again, 45.35. It's pretty nominal. When you're talking, 25, 30 points, like total range in here, it's pretty nominal. This next week of trade, remember, we're in a holiday week. You're looking for plus or minus roughly a $50 expected move. And again, I think that a lot of this anticipation of movement will be driven in very large part by the bonds. Look for bond sell-side activity. I think that's where the risk, really resides in the broader S&P, is if the bonds start to actually sell off. Bonds selling off will actually then cave the big monsters of tech. The monsters of tech start selling off. You start to see volatility come up. But keep in mind, for volatility to really get rocking here, okay, my opinion, in the month of September, we are going to need, again, as I said, some fear and loathing inside of this marketplace, big outside shock to come in to wake up volatility. And from that point on, again, volatility will rage. Thanks, everybody, for joining us here on this weekend update at TheoTrade. Back on Tuesday morning at market open. Bye-bye.